Hey guys, James here with Waterford Business Solutions, and we work with our clients a lot to make sure not only that they have accurate financials, but that they actually understand their financials every single month and every single quarter so that they know where they are in their business, how their business is performing, and what they can do ultimately to hopefully perform better and become a larger business and grow their business. But with those financials, it's all about ensuring that those reports are correct, ensuring that they're accurate, and ensuring that they have all the information that the client needs. Because if they aren't correct, there's a lot of information that will be wrong and that will ultimately hurt the business in the long run. There's always three financials at minimum that you want to be looking at every single month: your profit and loss or income statement, your balance sheet, and your statement of cash flows. And there's two other kind of ancillary ones: your accounts receivable and accounts payable, that also feed into these reports. So we wanted to take some time this week to discuss with you why making sure all five of these reports are accurate is so important and what happens if these reports aren't accurate. So we're going to start here talking about the accounts receivable and accounts payable reports. While they are not the primary reports you should be looking at, these two reports feed a lot of information into your P&L, balance sheet, and statement of cash flows. So we really want to make sure that we start with making these reports accurate. With the AR is all about who owes you money, and it should say pretty much, these are the jobs that I have finished or have some type of billing need on, and that customers owe me money on for jobs that I've done some type of work, whether it be a rough-in, whether it be a full install, whether it be a service call. If you've done work and the customer owes you money at all based off of your billing schedule, it should be on the accounts receivable report. If this report is incorrect, then we're not going to have the correct income on your P&L. We're not going to know how much money you're actually owed by your customers or how long it's taking your customers to pay you. Because the key metric that we want to look at is days to get paid. If it takes you a lot of days to get paid, there's a higher chance of customers defaulting on you. If your income's incorrect, all of your KPIs, material metrics, labor metrics, everything like that are going to be put off. We'll talk a little bit about that on the P&L, but making sure the AR is correct is all about making sure that the income on our P&L is correct, making sure that what we're owed on our balance sheet is correct, and making sure we have a proper understanding of what we need to go and collect and how long it's taking us to collect, so we can put in proper policies going forward to get our money in a timely manner, and we have less of a chance of default or bad debt there. Now, as far as the AP, accounts payable, it's kind of the same concept, but instead of who owes you with your customers owing you, it's who you owe. So it's all about what vendors do you owe. And if this is incorrect, we don't know the correct expenses, how much you actually spend on materials in the given month, theoretically for the jobs that you completed in that month, and how much you owe your vendors. We want to make sure that that AP is correct so that, again, our P&L is accurate with how much we spend on materials or anything that is in that AP area. Again, KPIs on there. We'll talk about that with the P&L. But also our balance sheet is correct as to how much we owe people so that we know, hey, I need to plan on paying this much coming up, and you keep cash reserves set aside to pay that instead of being like, oh, I've got money on hand to go buy a vehicle. Again, we'll talk about that a little bit with the balance sheet. And we also need to make sure that we are complying with your vendors' due dates. That way you're not getting late fees or anything like that, or getting freezes on being able to buy materials or anything there. We want to make sure that we are staying on top of what we owe our vendors and drawing it out as long as we can to keep from paying them, but also making sure that we've got the details so that we can pay them in a timely manner and keep those accounts in good standing. Now, with both of those reports, both of them are feeding on to our other three reports that you should be looking at every single month. We're going to start with your profit and loss or your income statement. And the whole point of this is to understand the profitability of your company. It's not saying, oh, this is how much money you have in your bank account at the end of the day. That's what the statement of cash flows is for. But this is about understanding how much profit the business turned around. So that way we're looking at what sales you made. We want to make sure, again, the AR is correct so that the sales on the profit and loss statement is correct. Where did we spend money? Where are our materials? Where are our labor? Where's our advertising? All of that so that we can pull key KPIs such as labor metrics, material metrics, client acquisition costs, everything like that. We want to be accurate on the P&L so we can pull all of those key KPIs. That way we can make sure that we are being compliant with industry norms. If you have a super high labor margin and you aren't compliant there, that could be a sign of overstaffing and we need to cut staff or something. So the P&L helps us understand that. Same thing with materials. If our materials are consistently super high, we need to probably look at increasing pricing. If you're constantly spending too much on advertising, we need to make sure that you're getting a good ROI on your advertising there. So the P&L gives us all of those really key financial KPIs that you should be looking at, like what you're spending on your vehicles, what you're spending on your labor, direct versus indirect, what you're spending on materials, advertising, insurance, all these areas. So we need to make sure all of this is correct so that we can consider and discuss those KPIs on a regular basis, preferably quarterly, maybe monthly. It kind of depends on you. I recommend monthly, but at least quarterly you should be looking at all this to ensure that your key KPIs are all being tracked and are all in a good area. The other thing that we want to make sure the P&L is accurate for is if that income statement or profit and loss statement is wrong, then we have a false sense of where these KPIs are, where your profit is, and we may think that you're making money on a business that's actually losing money. So we've got to make sure that we're keeping that accurate to ensure the business is being run as efficiently as possible. And at the end of the year, the profit and loss statement is the biggest thing that determines your tax liability. So if we can keep that P&L statement accurate throughout the year, we have a better idea of where you're going to end the year with for tax purposes so that we can do better tax planning, make sure that we put in better amounts of estimated tax payments, figure out other ways that we might be able to save money on taxes. All of that is really done through your profit and loss statement. So ensuring that accuracy helps you run your business better, helps you plan for taxes better, helps you plan for the future better, and helps you make adjustments to the day-to-day operations. So the P&L is arguably the most important because it keeps all of your KPIs accurate. However, the P&L doesn't stand alone. One thing that was taught to me as I was kind of starting out with accounting is if we look at just the profit and loss statement and ensure the profit and loss statement is accurate, then we're sitting on a three-legged stool with two broken legs. You are going to end up having to balance, you'll likely eventually fall and have issues there. So we want to make sure that we are looking at all three of these key statements, the balance sheet and the statement of cash flows, because they are all interconnected. So just because the P&L is looking accurate overall doesn't mean the balance sheet is accurate, and the balance sheet feeds into the P&L statement. The balance sheet is where we see our accounts receivable. Why I talked about that first. If the accounts receivable on the balance sheet isn't correct, then the income on the P&L isn't correct. The balance sheet is where we have all of your liabilities, all of your loans. If the loan balances aren't correct, that means we don't have the interest expenses correct on your profit and loss statement. If your credit card balances on the balance sheet aren't correct, then we don't have all the expenses recorded on the books or on the P&L correctly. So if the balance sheet is incorrect, the P&L will be incorrect because every single thing on the balance sheet pretty much ties into what's going on the P&L because we're looking at your assets. your fixed assets, your vehicles, machinery, equipment, your liquid assets, your bank accounts, savings accounts, anything like that, your kind of intangible assets like goodwill or non-compete clauses or anything like that, and your short-term or current assets such as your accounts receivable, loans that you've given out to other people and or employees and everything there. But it also shows us your balance sheet, your liabilities with what do you owe your vendors? What do you owe the credit card companies? What do you owe for long-term liabilities and short-term liabilities? If the balance sheet isn't correct, it's going to make the P&L incorrect. And the other big thing that we want to look at with the balance sheet is understanding what do I have to pay with my liabilities for principal, et cetera, coming up here. Because if we don't have enough assets, enough in our bank account to cover that, we could then default on a loan, or we'd have to take out another loan at potentially a higher interest rate to keep all of that accurate. So we use the P&L to understand the profit coming into the business, and then we use the balance sheet to look at everything and say, okay, this is the profit coming into the business, this is how much I have in profit to spend, and am I able to cover all of my liabilities with this profit? That's another key financial KPI. It's not an industry-specific KPI, but being able to cover your liability payments and your interest payments with the income coming in from the business is very important. So we want to make sure we're looking at that with the balance sheet on a regular basis to ensure everything. The other thing is we've got to make sure if you get rid of vehicles, we pull those off the balance sheet because those are no longer assets of the company. And we've got to pull those off for tax purposes and potentially recognize gains or losses depending on how you're depreciating everything, and keep that accurate, because if we're showing more assets than the company has, A, when you go to try to sell the company, it's going to be a lot messier. B, if you go through an audit, it's going to be a lot messier. And C, day-to-day operations of the business, you're going to show all these assets that don't actually exist. So we've got to make sure we keep all of those assets clean along with the liabilities and keeping those accurate, because all of that ultimately comes down to the equity of the company. The whole premise of the balance sheet is assets equals liability plus equity. Well, if you're at all ever been through middle school, you've probably taken algebra. So if we do a simple modification to this equation and we say assets minus liabilities equals equity. Well, equity is what you as the ownership have in this business. It's pretty much what your ownership value of this company is worth over the entire time that you've had it. So we want to make sure that that equity is accurate so that we have a good idea of your ownership value and your value in that company from a financial standpoint. So if we can't keep the assets and liabilities correct, the equity is not going to be correct. And if you are trying to sell the business or talk to someone about the value of your business, that equity number is a huge factor. The third statement is the statement of cash flows. And it's really taking and combining the balance sheet and the P&L together to show you where your money's going. You made this much in sales. This much you didn't physically receive, it's still accounts receivable. That's going to be something on your P&L. This is new assets you acquired. This is what you paid down in liabilities. This is what you took out in new liabilities. This is an account that's super important to understand at the end of the month or end of the period that you're looking at. This is how much free cash you have. If your statement of cash flows is consistently negative, that's a bad sign. It's a bad indicator of the performance of the business. But if it's consistently positive, that means the business is constantly gaining equity, gaining assets, gaining traction. Now, there's a lot of reasons that your statement of cash flows could be negative. You as an ownership may be taking big draws out that aren't really affecting the company profitability, but it's affecting the money left within the company. And if we're exceeding draws that the company can't sustain continuing to give, it's going to eventually harm the company. I see it time and time again where small business owners live off of their company, and their company is newer or their company is struggling and they have to live, so they're taking all this money out, but they end up starving out the company because they're taking so many draws and they don't leave enough in the company for it to be able to sustain and run itself. So it's super, super important that we keep track of all of that there and ensure ultimate accuracy there with that statement of cash flows. The P&L is the most important thing to look at, and the balance sheet is very, very important, but the balance sheet really isn't going to tell you a ton, but the statement of cash flows will tell you way, way more because it's telling you where all that money is going. But if the P&L isn't correct and the balance sheet isn't correct, the statement of cash flows isn't correct. And if the statement of cash flows isn't correct, you don't truly know how much in the positive or how much in the negative each month you are with the operations of your company. So we want to make sure we're staying on top of that statement of cash flows and keeping the P&L and the balance sheet accurate so that the statement of cash flow stays accurate so that you can say, wow, we're consistently losing money. It's time that we make a change. Or, wow, we're doing really good. Maybe we can go ahead and invest in that new building. Maybe we can go ahead and buy that new vehicle. Maybe we can, whatever it may be that you're looking at doing. So all of these reports are super important to be looking at, but it's more important to ensure that they are accurate every single month, because if you're looking at an inaccurate report, you're looking at false information. As always, guys, thanks so much for joining us here. I hope you found this informational. If you've got questions as to whether these reports are accurate for you, or you want better understandings of what they're telling you, what they mean, feel free to reach out to us here at Waterford Business Solutions. Shoot us an email at info@waterfordbusiness.com or give us a call at 864-351-0852. If you found this informational, join us every single Monday to get videos just like this. We put out videos every single week just to help you better understand, grow your business, and be a master of your own money. So go ahead and like, subscribe, turn on notifications, and or share this video with anyone that you think might be able to benefit from it. Until next week, have a wonderful rest of your day.